Hello to our listeners, and welcome to this month's Market Advantage podcast by Optimal Blue. As always, I have Brennan O'Connell joining me here today. We'll spend a few minutes talking about rate lock activity from November, and then we will welcome this month's guest, Agha Mirza from CME Group, to talk about a new partnership between the CME Group and Optimal Blue to launch a futures contract. So, Brennan, good to see you there. Happy belated Thanksgiving. We have the holidays right around the corner. And tell me, what do we have to be thankful for on the origination front with November now in the books?
Yeah, happy Thanksgiving, Olivia. November. Let's see. I'll start with the bad news. So rate lock volumes are down 25% in November. Rates hit their highest level since early July. Purchase lock volumes were down 21% month over month, and cash out and rate term refi volumes fell 20 and 50% respectively. However, year over year metrics provide some reason for optimism for us. Total volumes were up 12% from November of 2023. Purchase volumes were up a more modest 5%, while cash out and rate term refi volume saw a material 35 and 95% increase year over year, respectively. Purchase lock counts, a preferred metric, I've mentioned this in previous episodes, our preferred metric for measuring market health. We're down slightly, just 3% year over year. It broke a 2-month trend of positive momentum. That said, when controlling for the number of business days in November of 24 versus 23, I think we were at 23 in 23 and 22 in 24. So if you control for that, the trend actually continued from September. So we were up again. I think it was just about 2% year over year. So still some good reason for optimism that underlying origination volume in the purchase market is continuing to see positive trends year over year.
Got it. So tell me about the rate environment. Any good news to share there?
Yeah, it wasn't all bad. There was some good news in the market heading into the Thanksgiving holiday. The rates were higher for most of the month. The week leading up to Thanksgiving, though, provided a welcomed rally. The OBMMI 30-year conforming fixed rate index, the benchmark, which we'll be talking about with Agha. It's going to be the underlying index used for the Chicago Mercantile Exchange's future contract to be released in January. That benchmark finished the month down 11 bips from October. Our 30-year FHA and VA rates fell as well, closing the month down 7 and 20 basis points, respectively. 30-year jumbo rates did show a slight increase to close the month, up 16 basis points from October. There's a reason for optimism, though, just across the board as we look toward the final month of 2024. What I think is really interesting is how borrowers and lenders are adapting to this rate environment. So the more difficult rate environment and associated affordability challenges have led to another strong month for FHA production. FHA share rose at the expense of all other loan types, taking another 0.75 of a point of market share and accounting for 20% of total production. FHA share is now back near its peak of just above 22% of all production, which was seen last November, actually, in 2023. VA share fell in November, but is up year over year and sits just above 11% of total volume. So government production in total, which I think as you see affordability challenges creep in, tougher rate environment, you're going to see more of this govy lending, now accounts for nearly 1/3 of all volume.
Very interesting. So what about conventional lending? What's the story there?
Yeah, like much of our metrics from November, it's a bit gray, a little bit of good, a little bit of bad. For our Star Wars listeners out there, I'd say only Sith deals in absolutes. Anyway, conforming loans. Those underwritten to meet Fannie and Freddie guidelines continued to fall in terms of market share. Conforming share now sits below 53%, roughly 20 percentage points lower than the peak level seen in spring and summer of 2020. So this trend that really, conforming share peaking during the pandemic and then in kind of the current rate environment and affordability challenges, just continuing to see sort of a downward slope over time. On the other hand, within the conventional space, you see non-conforming lending, which includes both non-QM and jumbo. It did fall slightly in November, but it remains near its recent highs at just under 15%. So that's nearly a 5 percentage point increase in market share over the same period last year. Just a few other odds and ends we noted. Purchase credit scores were flat at 739, while average scores on refinance locks dropped slightly in November. Cash out average credit fell couple points to 695, and rate term average credit dropped 1.2730. And the average loan amount dropped again in November, decreasing from 380K to 376K, with average home prices falling in kind, dropping from 482,000 to 477,000 to close out the month.
Thanks, Brennan. Appreciate the recap of data from November. Before we welcome Agha, I do have to give everybody a reminder that Optimal Blue will be hosting its inaugural user conference, the Optimal Blue Summit. We'll be in sunny San Diego, February 3rd through 5th of 2025, and we genuinely hope to see you all there if you haven't registered already. Sessions will be built for everybody across the mortgage ecosystem, and we have a lot of special and interesting guests on tap. Brennan, what guest are you most looking forward to?
Well, it's a long list and a growing list. Obviously, we got Tony Hawk, but many of the sessions are going to include a lot of industry experts. One that we've been talking to most recently is our friends over at Richie May, who are going to, I think, do a really interesting presentation on data visualization and how best to leverage data to build out KPIs in Domo, which they're sort of the exclusive implementer of in the industry.
Excellent. That'll be a great session. And if you have not heard us talk about the summit before, yes, you heard that right at the beginning. Legendary skateboarder and entrepreneur Tony Hawk will be a keynote speaker. Personally, I'm really excited for Sarah Wheeler, editor-in-chief of Housing Wire. I'm a big fan of journalism and everything the folks at Housing Wire do. So hope to see you all there. All right, it's time to welcome our guest. We have Agha Mirza. He is Managing Director and Global Head of Rates and OTC Products at the CME Group. Agha, welcome to the Market Advantage podcast.
Thank you, Olivia. I greatly appreciate this opportunity, and thank you to Optimal Blue for this.
Yeah, Aga, so great to have you on. Really timely discussion we're having today. Optimal Blue and CME just announced a partnership between the two companies to launch a mortgage rate futures contract based on the Optimal Blue 30-year conforming index. So very excited today to talk about that contract, which will be based again on the Optimal Blue mortgage market index. Folks should be familiar with it. It's out on Bloomberg. It's on our website. It's been out for several years, updated daily. So we're going to be talking about that index and how it's going to be powering this futures contract launched by CME. And then we're going to talk all things CME. So many of our mortgage lender listeners may not be familiar with CME. So I think really good opportunity for us today to hear directly from you, Agha, about the CME and how the CME is doing a lot more now in the mortgage market.
Yeah, why don't we take that opportunity to hear more about what CME Group does, as well as your role there, Agha?
Absolutely, Brennan and Olivia, that's a great place to start. So, for your listeners, just briefly, CME is the world's leading futures and options exchange. It provides deep, large, and liquid markets across a range of asset classes, ranging from interest rate, fixed income, which is my area, equities, foreign exchange, crypto, commodities, agriculture. And what's remarkable about CME futures and options products is that we are equally strong and leading in all of the asset classes. So now let's move to what I do. I am managing director and global head for rates and OTC products. So I am in charge of the interest rate business that includes products such as, and you may have heard about these, Treasury futures and options, SOFR futures and options, credit futures, swap futures called ERIS. And now we are very excited to get into the mortgage space that I guess we will be talking about.
And we're so glad you are, Agha.
So perhaps I can share a bit more about how we think about our place in the mortgage market and what we can offer and how we can help your mortgage lenders and other industry participants with regards to mortgage related products. Just a bit about the journey that we have been on in the recent decade or last 10, 12 years, even though I should note that CME is at the last I checked, was a $170 4-year-old exchange. And please pardon me if I'm off by a year or two. Time flies quickly. So, and obviously, Treasury futures, our flagship product, was the first one to be created in 1977. But let's bring us to some more recent history and fairly quickly. I think coming out of global financial crisis, everyone or most of us in financial markets learned about the at the time upcoming Dodd-Frank Act. Dodd-Frank Act and another piece of significant banking regulation called Basel III. They were both expected to get into our industry from a regulatory point of view and impact market structure, impact cost of trading, and the type of products that make sense. And so if I stand back in 2013, there was already significant concern about rising capital charges on bank balance sheet and its impact on the liquidity that bank dealers provide to in fixed income markets, as well as there were going to be increased margin requirements on derivative trades. Seeing what is coming, and which is all of our jobs in our respective industry, in our respective professions, we engaged with clients and sought to solve their problems and deliver on their needs as much as possible. What that meant was that the treasury futures and we are so-called exchange listed products, standardized listed products. So for futures and options, the fact that they are margin efficient, that value proposition got amplified in the context of being in 2012 and 2013, looking ahead to the next 10 years. We went on a journey to proactively and consciously working with market participants, innovate our products, our services, and our tools. And essentially, with the objective of providing balance sheet, margin, and capital efficiencies. That multi-year journey has worked out well. And if I'm being honest, way better than my expectations. Today, depending on how you measure our markets, be it average daily volume, open interest, which are open positions, large open interest holders, it's a count of open interest holders published by our regulator CFTC. On all those measures, our business has nearly tripled or more than tripled since 2012-2013 period. Treasury futures back in 2013 were an estimated 54% of the entire cash treasury market. Today, they are 113% of the cash market. In other words, treasury futures at CME alone trade 13% more than cash treasury securities that are trading across dealer to dealer and dealer to client platforms. And by the way, when we talk about the treasury market, it is a $28 trillion market. And in relation to the day-to-day secondary trading of that, we trade 13% more in futures form. So now I'll come to mortgages. Now that the market is in a good place and many more participants, especially asset managers, buy-side clients, are using futures as one of their leading products, if not their primary fixed income product, clearly they all are very accustomed to trading futures at CME. They are very much enjoying the benefits of standardized treasury futures and SOFR futures and so on, and the fact that these products trade in our global equal access markets. But at the same time, there is now a record $1.4 trillion tied to interest rate derivatives in margin. So the participants continue to look for margin and capital efficiencies. And that, the margin that is tied to interest rate derivatives, a lot of that is in uncleared space. And a lot of that has to do with the regulation that is already in place and the fact that over years, thankfully, the US and the world economy continues to grow. And the fixed income markets have grown, which leads to more derivatives and therefore more margins. But the hunt for margin and capital efficiency is still there, which means that the time is right for futurizing the $300 billion a day mortgage market. So the $300 billion a day mortgage market is second largest over the counter market behind the US Treasury market. So clearly a very, very important market. And in terms of working with Optimal Blue, which we are very excited about, we will be launching a specific product that we are naming Mortgage Rate Futures Contract. But the long form of that name would be a monthly futures contract that cash settles to Optimal Blue 30-year mortgage rate lock index. And this index accounts for 35% of all mortgage rate locks that take place in the United States. So clearly highly representative and the leading index in the market. And then final point I'll make is that 2 years ago, we launched TBA futures. TBAs, or rather TBA forwards, are the primary mechanism for trading mortgage-backed securities in the OTC space. We have launched futures versions of that that primarily provides access to mortgage originators and the holders of servicing rights, middle market clients. But, in addition to everything that we just talked about, the fact that many participants are using Treasury futures in significant ways, and that makes the world very accustomed to trading futures. In addition to all of that, through the TBA futures and through our overall fixed income distribution, we have a growing network of mortgage originators and service right holders. And finally, while TBA futures and OTC TBA forwards are the mechanism that is being used today, a number of participants, including mortgage lenders, have exhibited demand for the primary mortgage rate exposure. Both MBS and the mortgage rate include prepayment risk. However, this contract tied to Optimal Blue mortgage rate lock index will be the first one that has primary rate exposure or primary rate exposure with prepayment. The other instruments essentially have an element of secondary market, their own specific supply and demand and things like that.
Aga, that incredibly helpful context, I think, for all of our listeners to understand the journey that the CME took into this space. Certainly happy that you did it. That I think there's so many efficiencies for many of our clients that they're going to be able to pick up based on the new products that you're launching. I think about the portfolio of products that the CME now offers between the TBA futures, the recently announced Optimal Blue primary rate futures that are going to be launching in January. You now have this opportunity to manage all components of that mortgage asset, both in the pipeline and then as well after the loans have been originated, funded, and then you're holding them in a portfolio, whether that's a servicing right or the actual mortgage asset itself. You mentioned it, the exposure to prepayment risk, this primary rate input here that's going to be driving these futures contracts, or is the underlying benchmark for the futures contract. That's going to be taking into account the margin component or the primary secondary spread that's built in by the originators. And so what a great way for the CME to continue to help with folks on the risk management side, as they're going to be looking to manage the risk from prepayment, in addition to all of the capital market risks that CME has already launched the products to take care of. So really an exciting development, and I think really powerful to see the CME. You talked about a 175-year-old entity coming into this space, and for many of our lenders, they're used to trading in maybe a different way, and so now you've got this large, well-established exchange coming into the mortgage space. What's going to be different for mortgage lenders today who are used to trading maybe just traditional TBAs? What's different for those folks who are going to start to think about leveraging some of the products that CME offers?
Absolutely. It's important to discuss the differences as well as what I hope are significant benefits of trading at CME using the mortgage rate futures contract. So, I may say this more than once in the conversation because obviously I'm talking about CME centralized markets and cleared products. But at a high level, who are we? We are an exchange. That means that we run an anonymous, all to all electronic centralized marketplace where, those who have onboarded can trade seamlessly and efficiently. And as soon as the trade is done, it's a derivative transaction, futures or options or swaps with the party that traded in our centralized markets, futures or options, faces CME clearing, which guarantees all the trades and risks manages them. When it comes to the OTC TBA market, which is where likely your mortgage lenders and other listeners to this podcast are going, in the OTC market, clients needs to establish relationships with dealers and enter into the so-called master securities forward transaction agreement. The dealers themselves typically are members of FICC's MBSD division. MBSD division is the mortgage clearinghouse within DTCC and FICC, which is essentially the industry utility for cleared fixed income securities. So dealers in their dealer-to-dealer market hedge through clearing at MBSD. But the clients who have signed this master securities agreement, they remain bilateral with dealers. Now you'll see that that is significantly different from what I just described. The moment you trade the mortgage rate future or the TBA future or treasury future, you automatically face the single CME clearing Inc., which is basically which has the highest ratings and which provides seamless, highly efficient electronic workflows. The key difference in experience is that you don't need to negotiate paperwork after you have been onboarded by clearing member or broker who you would trade with. That primarily involves account information and some other details. And after that, it's just a seamless electronic process. And your each trade is with the single counterparty, which then opens doors for additional efficiencies.
That's very helpful. And I think continuing on that efficiency discussion, there's another area that we've talked a lot about as we've kind of developed this partnership, and it's the concept of cross margining. So the advantage of having different products on the same exchange. A lot of our lender clients maybe are already trading treasury futures. Maybe they've got OTC, TBAs, which are part of their risk management structure. But what is it that this cross margining, which is, it's kind of a specific topic, but I do think it's an important one to cover here. What is it about that, or how does cross margining work, and how is that going to improve really the cash utilization of our lender clients?
Yeah, and I think it's a great point to briefly discuss the concept of margin itself. Throughout our prior discussion, we have mentioned the word margin, and I'm sure that most of your listeners are familiar with the concept. But essentially, margin is the amount of money that you have to put up to be able to trade a futures contract. What is great about, let's say, mortgage rate futures or TBA futures versus a comparable exposure through a mortgage-based backed security is that you don't need the full amount. If you have exposure, let's say, of $10,000 or $100,000 that you're looking to hedge, then there will be a number, be it 7% or 12% or 17%, some number of some percentage of the amount of exposure that you were about to hedge or risk manage on the exchange traded product that you will deposit with your clearing member, and that's called margin. Now, most people like to hedge. It's completely makes economic sense and like to take the exposure they need to take, but also keep their cash and capital in hand for various reasons and for multiple uses. So cross margining is the ability for CME clearing to look at a participant's or a client's offsetting positions. So, for example, if a participant is short mortgage rate futures and long treasury futures, our clearinghouse has the world's leading risk management team, analytics. So we have regulator approved models, and through constant work with regulators and our clearing members, we specify the percentages of offsets, and that's based on the fact that mortgage rates and treasury rates are correlated. So, based on those correlations between different asset classes at any given point in time, if we provide cross margining, there are typically specified offset percentages that we use, and that enable for us to charge less margin. So if you have, a long position in one contract and a short in another that are offsetting in correlated instruments, then you don't have to put the sum of individual margin requirements. In fact, in some cases, you would be putting less than the margin requirement of a single position. And that's the concept of, offset. I'll say one more thing. Some of your mortgage lenders may not expect to have offsetting positions often, but they actually are very good beneficiary of cross margining as well. And that how is that? That is because the larger institutional clients, the banks, they have very large exposure, fairly involved, complex portfolios, and they certainly are optimizing their margin. And often, in many cases, they trade our products because of efficiencies such as cross margining. So, if cross margining becomes an attractive feature, a value proposition for bringing a large bank or large institutional client into the market, then that injects liquidity. Naturally, that means that there are more need to buy and sell, natural buyers and sellers, and that leads to people showing standing bids and offers. So the bid offer spread is referred to as liquidity, which essentially is the ability to readily buy or sell exposure with little slippage. So if you have offsetting positions, you could benefit from cross margining directly, but if you don't, then cross margining is helping to bring more participants, big participants, and additional liquidity.
That's really helpful. The benefits, you listed them. It's really myriad. I think and for different clients, it's going to be different benefits, right? So you talked about depositories who might have a portfolio that they are managing, which includes not just mortgage assets but other types of fixed income instruments, and there's the obvious benefits there that they are very likely already engaged with the CME, so it makes their risk management costs that much lower within their mortgage portfolio. Even for non-lenders, I think about folks that are managing maybe a pipeline as well as a servicing book, and oftentimes, these assets might behave in opposite directions, and cross margining now with the ability to have your risk management infrastructure have an offset because you're working with a single counterparty at the CME is really powerful. So again, this is we talk about it a lot here at Optimal Blue. We're focused on profitability of our clients and ultimately get more folks in homes. And in many ways, this is going to lead to both. So I know we're coming up on time here, but we do just have one more question, Aga, that we want to make sure we put a pin in here because we did hit on it a bit. But pros of having a single counterparty like the CME versus today, many mortgage lenders are used to working with a variety of different broker dealers. Can you talk a little bit more about that experience and what our mortgage lenders who aren't working with the CME today might come to expect?
Yes, that's a very important point to further make some comments on. As we said, you are not signing multiple agreements with multiple dealers, less paperwork. You are not maintaining positions and exposures with multiple dealers because obviously, when one participant, for example, a mortgage lender, has a need to buy or sell, Bank A may have a better price than Bank B, so they'll trade with Bank A. Later, when they have another need, then Bank B may have a better price and they'll trade with Bank B, which then leads to open positions with multiple parties. What is unique with CME is that there is a single equal access global all to all market. So, everybody is aggregated in there, which means that the same experience of trading with party A and party B will feel same. You'll just trade on the best price. And as I said earlier, you're not maintaining multiple relationships and keeping multiple open positions. And also, there's very little, if any, counterparty credit risk in facing CME clearinghouse. You all know that counterparty credit risk in the OTC market is a key consideration that always needs to be paid attention to. So obviously there is that simplification that CME Clearing Inc. is highly rated, and you go through the paperwork once. And that is why when there is let's say, a bit of stress in the markets or potentially a credit crisis, and I'm not wishing for one, but if there is some kind of stress, then there is, as has been seen throughout our 175-year type history, there is no concern about trading against CME clearing. And that is why everybody comes to the single marketplace, so you also get better liquidity in times of stress. So lack of counterparty credit risk, lack of papering and multiple relationships, better liquidity, those are some of the benefits.
Perfect. Well, Aga, this has been so insightful. I speak only for myself, but I have learned a lot in a short amount of time hearing you and Brennan discuss this. But to bring us home, I would like to ask you a bonus question that we ask of all of our guests. So, as you may know, our mission statement at Optimal Blue is to help lenders maximize their profitability on every loan transaction so that they can in turn get more aspiring home buyers into homes. So, with that in mind, in your opinion, what is one thing an originator should be doing in today's market to maximize profitability?
You know, we live in a evolving, changing world. Change is the only constant, as I'm assuming an ancient Greek philosopher said. So I'll assume that your listeners are caught up on data analytics and technology and looking at AI and things like that. Why don't I suggest something from our vantage point, our expertise? I would suggest that the originators, mortgage lenders, pay attention to and learn about the relationship between primary mortgage rates that the optimal blue index captures and the secondary market rates that market participants are used to, mortgage-backed security rates, TBAs, swaps, and treasuries that they may be using or hedging with. And what I mean by the relationship is that I personally would expect discussions or published content, be it from CME or Optimal Blue or industry strategists, some kind of discussion or hopefully more significant research highlighting the relationship between primary mortgage rates and secondary rates. And if participants pay attention to that, then they can come up with their own framework and their own rules of thumb or more specific analytic approaches to try and buy and sell instruments that are more advantageous for them. In our trading industry, that's called the concept of relative value trading or optimizing your risk management and hedging needs in relation to relative value trading. So I would urge them to keep an eye out for that discussion or published content.
Perfect. Thank you. You are certainly speaking our language here by connecting the primary market to the secondary market. So, really excellent answer. And thank you so much again for all of your insights and for taking time to join us today. And thank you to all of our listeners for tuning in. Brennan and I will be back in January with another episode of the Market Advantage podcast and more data insights. Take care.
Thank you.
Be part of an event that will shape mortgage innovation and lender profitability. This client-exclusive event will feature sessions exploring AI trends, profitability strategies, market insights, and more. Plan to attend the Optimal Blue Summit from February 3rd to 5th, 2025 at the Marriott Marquis San Diego Marina. Don't miss your chance to shape the future of mortgage technology. Register now at summit.optimalblue.com.